Welcome to the Deep Dive. Today we're plunging into the latest financial results of Dr. Reddys Laboratories Ltd. for Q1 FY26. We've armed ourselves with quite a stack of their investor presentations, earnings call transcripts, and the official financial statements. Our mission really is to cut through all the numbers, decode the corporate speak, and just pull out the most important nuggets of knowledge for you. Think of this as your personal shortcut to understanding a major global pharmaceutical player's health, its strategic plays, and, what it all means for the broader industry and maybe even your everyday life.
Absolutely. And what's truly fascinating here is how a company like Dr. Reddys doesn't just navigate these complex global markets, it actively carves out its path. From the constant complexities of, say, generic pricing battles to pioneering new treatments, it's really a masterclass in adaptation. So we'll explore their overall performance, zoom into specific business segments, analyze their financial backbone, and definitely peer into their strategic future.
All right, let's pull back the curtain then on this quarter's performance. Every company tells a story with its numbers, right? And Dr. Reddys Q1 FY26 narrative seems like one of resilience, maybe some strategic shifts. What were the opening chapters, the big headlines that jump out from their consolidated figures?
Well, looking at the big picture, Dr. Reddys delivered steady double-digit revenue growth. That was 11% year over year, which hit about 85.45 billion. That's roughly 997 million US dollars.
Okay, 11% year on year, solid.
Solid jump compared to last year, definitely. Although it did remain flat on a sequential basis, so basically held steady compared to the quarter just before this one.
And on the profitability front, how'd they fare there?
Their EBITDA margin, that's, earnings before interest, taxes, depreciation, amortization,
Right.
a key measure of their core operational efficiency.
Right.
It came in at 26.7%, which is actually modestly ahead of their own aspiration of 25%. So that's good news for them.
Better than planned. Okay.
Yeah. Profit after tax attributable to equity holders. That saw a 2% year-over-year growth, reaching 14.18 billion, or about 166 million US dollars, though it did dip 11% sequentially compared to Q4.
Okay, so a bit of a mixed bag there, like you said, but generally positive year over year. What were the main engines driving this revenue growth forward?
The strengths came from a broad base, which is always a good sign. Not just one thing firing. Key contributors included the acquired nicotine replacement therapy business, the NRT business. That provided a significant boost.
Ah, the acquisition.
Exactly. And also a sustained strong performance across their branded markets. And this kind of strategic diversification really helped offset some softness they experienced elsewhere, which I'm sure we'll dig into.
Yeah, that broad-based performance is intriguing. It really highlights their ability to find growth even when maybe certain areas face headwinds.
Precisely. And what's truly insightful here is how their diversification acts as a kind of strategic shock absorber, right? So while a major segment like North America faced price erosion, which we'll talk about, the robust growth you saw in Europe and India demonstrates a deliberate, successful strategy. They're balancing risk and leveraging different market opportunities almost simultaneously. It's not just diversification. It's like active portfolio management in real time.
Now, this is where the picture really starts to take shape, I think. Peeling back these layers market by market helps us understand the nuances behind those headline numbers. Let's start with North America, specifically the U.S. It's always a closely watched market for pharma. What's the story there?
Okay, so the North American business reported revenues of 34.12 billion, which is about 400 million US dollars.
Yeah.
And here's the significant point. This was actually an 11% year-over-year decline.
Oh, wow.
And a 4% sequential decrease as well.
An 11% decline in such a critical market like the U.S. That's significant. What does that tell us about maybe the broader trends in generic pricing, particularly for a product like lenalidomide? Is this an isolated issue or kind of a bellwether?
That's a great question. And it's probably a bit of both, really. The softness was primarily due to price erosion in selected products, most notably lenalidomide. That's the generic version of the blockbuster drug Revlimid, huge drug.
Right.
The timing of procurement by certain customers also played a role, apparently. Management stressed that while the base business felt this impact, they fully expect a pickup in new product launch momentum in the remainder of the fiscal year.
So they see launches helping later.
That's the plan. They did launch 5 new products and filed 1 new ANDA. That's the abbreviated new drug application for generics in the U.S. during the quarter. And they've got 70 ANDAs and 3 NDAs, the new drug applications for novel drugs, still pending approval. So while lenalidomide's erosion is maybe product-specific, it definitely highlights the constant pressure in generics. It's a tough space.
So a major challenge in the U.S. then. Was this a localized storm, or did other markets face similar pressures? Let's turn to Europe.
Europe was a complete contrast, a totally different story. Their European generic business saw a massive 142% year-over-year growth.
142%.
Huge number, reaching 12.74 billion, or about 131 million US dollars. And this was overwhelmingly fueled by that nicotine replacement therapy portfolio acquisition we mentioned.
The NRT deal again.
Yeah, it contributed 6.69 billion, about 78 million US dollars just on its own, and even saw a healthy 12% sequential growth. Plus, they introduced 13 new generic products across Europe as well, so strong organic effort too.
Wow, 142% jump. That NRT acquisition sounds like a real game changer for them in Europe. How did their home market, India, perform? Was it as strong?
India was also very strong, delivered 11% year-over-year growth and a 13% sequential increase too. Revenues there were 14.71 billion, about 172 million US dollars.
And what drove that?
Mostly new product launches and some strategic price increases. They managed to maintain their position as the 10th largest player in the Indian pharmaceutical market. And crucially, they actually outpaced overall market growth in India.
That's key.
It is. And they launched 5 new brands there, including 2 quite innovative assets, Beyfortus, which is an RSV vaccine,
Oh, great.
and SenseImmune, an immunotherapy product for house dust mite allergies. So it shows they're focusing on both volume and higher value innovative products back home.
Interesting mix. Okay, beyond India and the regulated markets like the US and Europe, where else did they see significant movement? Emerging markets.
Emerging markets, yeah. They reported 14.04 billion, or 164 million US dollars. That reflects an impressive 18% year-over-year growth.
18%. Nice.
Yep, primarily due to higher volumes and new product launches across multiple countries.
Mm-hmm.
Favorable foreign exchange helped a bit too. Their Russia business, specifically, delivered a strong 17% growth in constant currency terms.
Even with everything going on.
Exactly. And they launched a significant number, 26 new products across these emerging markets. It shows their broad reach.
Okay. And what about their pharmaceutical services and active ingredients segment, PSAI? That's their manufacturing and ingredients arm, right?
That's right. PSAI revenues were 8.18 billion, about 95 million US dollars. Now, this showed a 7% year-over-year growth, which is okay, but it was a 14% sequential decline.
Why the decline from last quarter?
This dip was primarily attributed to seasonal weakness, apparently, and lower operating leverage. Essentially, less efficiency, maybe due to lower production volumes in certain areas, and that also impacted gross margins for this specific segment.
Okay.
However, they do expect momentum to pick up in the coming quarters. They're aiming to get back to a double-digit growth trajectory for the full fiscal year for PSAI. And they also noted healthy growth in their CDMO business. That's the contract development and manufacturing organization side.
Ah, manufacturing for others.
Precisely. That contributed about $18 million this quarter. They're targeting $100 million for the full fiscal year from CDMO and projecting a massive $300 million by 2030. So that CDMO growth really indicates a strategic shift towards higher value manufacturing services. Big ambition there.
Definitely sounds like it. Okay, so beyond just the sales numbers and where they came from, region by region, how does their overall financial health look, and how are they managing their expenditures, costs, and all that?
Sure. So the consolidated gross profit margin for the quarter was 56.9%. Now, while this was a decrease of 3.5 percentage points year over year, that's 350 basis points.
Right.
Largely due to that price erosion we discussed in generics and maybe that lower operating leverage in PSAI. It actually showed a sequential improvement of 134 basis points. So they're regaining some ground on a quarter-over-quarter basis, which is positive.
Clawing some margin back. Okay. What about their investment in essential areas like selling, marketing, SG&A, and of course R&D? Are they tightening the belt or investing for growth?
Well, selling, general administrative expenses, SG&A, they increased 13% year over year, totaled 25.65 billion, or about 299 million US dollars.
So spending more there?
Yes. But the increase wasn't just, across the board. It was primarily driven by strategic, growth-oriented investments, specifically in that newly acquired consumer healthcare business, the NRT one, and also their Nestle joint venture for nutraceuticals. They describe these as strategic growth drivers needing focused investment. So spending money to make money down the line, basically.
Makes sense. Investing behind the acquisitions.
Exactly. And on the R&D front, spending was 6.24 billion. About 73 million US dollars. That remained broadly flat year over year, but it did decline 14% sequentially. represented 7.3% of sales this quarter, and they expect R&D investments to stay in the range of 7.5% of sales for the full fiscal year.
So holding steady on R&D as a percentage of sales.
Pretty much. And the crucial takeaway here, I think, is that they're making targeted investments. In complex generics, API-active pharmaceutical ingredients, and their biosimilar pipelines, it's about supporting long-term growth rather than just, throwing money at everything. Strategic R&D spend.
Got it. And when we look at their balance sheet, cash flow, what's the picture there? Are they generating enough cash to fund all these ambitious plans?
Yeah, they closed the quarter with a strong balance sheet. Reported a net cash surplus of 2,922 crores. That's about $341 million in net cash.
Healthy position.
Very healthy. Their capital expenditure CapEx cash outflow for the quarter was 683 crores, or $80 million. And they expect full-year CapEx in the range of 2,500 to 2,700 crores, mostly for peptides and biosimilars capacity.
Yeah, okay.
And importantly, they generated a solid euro 433 crores, about $51 million in free cash flow just during this quarter.
So essentially, they're not just growing, but they're building up a healthy, war chest.
Right.
Ready to deploy. That's a strong position to be in, isn't it?
Absolutely. You can think of it as having multiple financial levers at their disposal. They're not just surviving these market pressures, they're strategically fortifying. This balance of investment and robust cash generation positions them exceptionally well for the future, especially given some of the major shifts and opportunities they seem to be eyeing.
Speaking of opportunities, what is truly on the horizon for Dr. Reddys? What are their big strategic plays and future bets that could really redefine their trajectory?
Well, a major focus, and honestly a significant one for the whole global healthcare landscape, is advancing critical pipeline programs. Let's talk about semaglutide. That's a GLP-1 product. And, that class of drugs getting huge attention for diabetes and weight management.
Huge. Ozempic Wegovy generics.
Exactly. They are planning and gearing for product approval somewhere between the end of October to the beginning of November 2025. So next year.
Okay.
If approved, they aim to launch it almost immediately, right at the time of loss of exclusivity, which they expect in early January 2026. This is a huge, fast-moving market they want to jump into quickly.
That is a huge one. What about their manufacturing capacity? For a drug with such anticipated high demand, can they make enough?
Good question. For calendar year 2026, which is mostly their fiscal year 27, they're planning to have about 10 million pens of semaglutide available, growing to 12 million pens for FY27. And that's through a key partner, they mentioned.
Partnering for capacity.
Yes. They believe this capacity will be sufficient to gain meaningful market share, given the immense demand for this product class. And they also highlighted that their full GLP-1 portfolio actually includes 26 products. They see this as the beginning of a decade of GLP-1 products for them. It's a massive long-term bet.
26 products in that pipeline.
Right.
And what other biosimilars are they making big bets on beyond the GLP-1s?
The abatacept biosimilar is another key asset in their pipeline. It's a biologic for autoimmune diseases.
Yeah.
They expect a phase 3 trial readout in November 2025, so similar timing for news as semaglutide.
Okay.
Assuming a positive readout, they plan to submit the BLA, the Biologics License Application.
Right, for biologics.
To be on time for a potential market launch of the intravenous or IV formulation, the one given directly into a vein by December 2026 or January 2027. The subcutaneous or SC formulation, the one injected under the skin, that would launch about a year later due to intellectual property considerations. Patent stuff.
Still, another high-value, complex product potentially coming online.
Definitely.
Any new collaborations on the biosimilar front? Maybe to, share the development burden or the risk?
Yes, actually a very smart move here, I think. They've expanded their partnership with a company called Alvotech. They're going to co-develop, manufacture, and co-commercialize pembrolizumab. That's a biosimilar candidate to Keytruda, the big cancer immunotherapy drug.
Ah, Keytruda biosimilar. That's going to be competitive.
Exactly. It's expected to be a crowded market,
Yeah.
but this strategic collaboration allows them to enter it with a much less upfront investment burden. It significantly de-risks their entry. Smart partnership.
Makes sense. They've also been integrating that nicotine replacement therapy business they acquired. How's that progressing? Is it living up to expectations?
It seems to be going really well. The integration is progressing as planned, and according to them, it's actually exceeding their expectations.
Better than hoped. That's great news.
Fantastic news for them, yeah. Following successful integration in the UK and the Nordics, they're now preparing to onboard additional markets, places like Canada, Australia, and other selected countries across Western Europe. So that acquisition is proving to be a true growth engine for them.
Given all these strategic moves, the pipeline bets, the acquisitions, are they still actively looking for more deals, more partnerships, more acquisitions, or are they maybe pausing to digest what they have?
Absolutely not pausing, based on what they said. They are actively exploring strategic partnerships and acquisitions. Still hungry,
Still looking.
yes, looking to further diversify and strengthen their portfolio. They even highlighted a substantial financial capacity, something like $2 to $2.5 billion, including their ability to borrow, specifically earmarked for these kinds of business development initiatives. So this is a company with a strong appetite for more strategic growth. And if we, connect this to the bigger picture, this isn't just about incremental growth here and there. It suggests a very clear strategic pivot toward these high-value, complex generics and biosimilars, alongside targeted, impactful acquisitions. This whole strategy seems designed to drive sustained growth well beyond the traditional, often more competitive, basic generic segments.
Okay. To wrap up our deep dive, there were a couple of other important corporate updates that maybe you, the listener, should know about, just signaling future direction, stability, perhaps.
Yeah, just one main one, really.
Yeah.
On July 23rd, 2025, Dr. Reddys announced their intention to appoint a new firm, Ms. Deloitte Haskins and Sells LLP, as their statutory auditors. This would be for a period of 5 consecutive years, starting from financial year 2026-27.
Okay, a change in auditors.
Yeah, it's a significant change in their corporate governance structure, but it is subject to shareholder approval at the 2026 annual general meeting. So it's a routine, but still important change in oversight for the company.
Right. So what does all this mean for you listening in? We've seen a global pharmaceutical company, Dr. Reddy's, navigating the, well, unpredictable ups and downs of a complex market. They're leveraging strategic acquisitions like that NRT deal to power new segments. They're managing pricing pressures in key areas like U.S. generics. And they're making significant multi-billion-dollar bets on future growth areas like GLP-1 products and biosimilars.
Yeah, ultimately, this strategic pivot towards complex generics and biosimilars isn't just about market share for them. It's really a bet that could redefine access to cutting-edge treatments globally. It could potentially make advanced medicine more attainable for millions by leveraging their production capabilities and their pretty vast market reach. This long-term vision, supported by that continued investment in R&D and strategic business development, even despite near-term challenges like the lenalidomide price erosion. It paints a picture of a company positioning itself not just for the next quarter, but really for the next decade of pharmaceutical innovation.
They certainly seem to be playing a long game, it's clear. But with such big bets on these complex areas like GLP-1s and biosimilars, what are the biggest risks they're facing? Is there a scenario where this long game might not pay off quite as expected?
Oh, absolutely. That's the core question, isn't it? For any company with such an aggressive pipeline, the risks are substantial. You've got potential R&D failures. These things don't always work out in trials. You've got intense competition, especially in biosimilars. Regulatory hurdles can pop up unexpectedly. And of course, there's the ever-present threat of price erosion, even in these more complex segments eventually. Success isn't guaranteed, definitely not. But their diversified approach and that strong cash position, that war chest we talked about, certainly give them more resilience to navigate those potential pitfalls than maybe some others might have.
Fascinating stuff. Thanks for diving deep with us today on Dr. Reddy's Quarter. We hope you feel well informed and ready to connect these dots in your own world.